billion in Wrigley debt. Okay, so we need to factor those two items into the analysis. All right, and then in that next paragraph, it gives us some more good information. It tells us that this deal is going to represent about a 28% premium to the stock price on the day prior to the announcement. All right, it's a pretty high premium actually, 28%. Anybody following that Kraft Cadbury offer in the press? Kraft made an unsolicited bid for Cadbury, and it was like a premium, I think, of about 16%. And Cadbury's all up in arms. They've rejected the deal. They've said, you're undervaluing us. Not surprisingly, they're pointing to the Mars Wrigley deal and saying, well, they got a 28% premium. Where's our premium? All right, so that's how these data get used in the real world. A lot of sellers will look back on these. A lot of buyers will use these to formulate offers. Okay, they'll look at industry premiums and make sure they're kind of in the ballpark there. You can read the rest of this. It's really full of just a bunch of fluff from each side's management team. It's going to be the best deal in the world. We're creating shareholder value. It's the typical stuff we see. From our standpoint, we've got what we need. We know it's $80 a share. They're going to assume about $1 billion in debt. Premium is about 28%. We've got their prior day closing price, and we know that the deal is around $23 billion in value. All right, now the next step is let's go validate it. Let's look at an 8K. Okay, so I've included all the filings necessary to do our work, including this 8K for Wrigley. All right, 8K is pretty much straight to the point. Unlike a 10K where they're going to talk about the business overview and competition and management's discussion and all this, 8K usually jumps right into the issue. And on the second page, it basically tells us why they filed an 8K. They entered into a material agreement, definitive agreement, and plan of merger with Mars. Okay, and they talk about the structure of the deal, the holding companies, all that. Second paragraph, they say shareholders of the company will be entitled to $80 in cash for each share. Now here's where it gets interesting though. Here's where this deal is a little different than some other deals. Wrigley, as it turns out, had two classes of stock prior to the transaction. They had common stock and they had a Class B common stock. And this is the first mention we've seen of this, but basically $80 a share for each share of both classes of common stock. What that tells me is when I put my share count in, my share count needs to include both classes of stock. All right. So $80 a share. Another thing that they mention, and this is where precedent transactions, this is a key place where precedent transactions differs from a comparable public companies analysis. All right. Comparable public companies involves looking up the share price of the company in the open market and valuing each of our comps based on that price. That price is the price of one share. It's the price of a minority interest position in the company. Okay? A precedent transactions approach, however, involves a controlling interest. And something that's unique about employee stock option agreements is upon change of control, all options vest automatically. All right? So what that means for us, when we look at that options table, instead of looking at just the options that are vested, we look at all of the outstanding options because they all vest in connection with a change of control. All right, so that's just a kind of a sidebar. We'll take that into account when we dig into the options table in a few minutes. So that's good information. I think that's really about all that we need to spread the transaction. There is a mention of termination fees. Basically, if the buyer or the seller walk away, that is, maybe the buyer, gets the seller under agreement, gets them all excited about this $80 share price, and then walks away at some point, then they're going to have to pay a breakup fee, a termination fee. If the seller goes out and uses that offer to find a better offer in the marketplace, they have to pay a breakup fee to the buyer as well. All right, so you'll see these termination fees outlined. All right, it's basically so that both parties get some compensation in the case that someone walks away. All right, because what could happen if the buyer walks away and the seller has decided they want to sell? Now they've got to go find another buyer, and the price probably isn't going to be as high. And so that termination fee is made to compensate them for that loss in value. To the extent the seller goes out and shops it around and gets a better offer, well, they've just wasted the buyer's time. And so the buyer is going to get compensated for that loss of time, that loss of economic benefit as well for being able to buy the seller. All right, so that's what termination fees are. You'll usually see those outlined as well. All right, that's really all we need from the 8K. So we've validated everything we've seen in the press release. Now it's time to go into our model and we can start spreading the transaction. All right, so if we go back to the template, first thing we need to input on the deal is the consideration per share. And in this deal, it's only a cash deal. Basically, each share of Wrigley's common stock is going to get $80, so we're going to enter 80. And the stock value per share I put as 0 because, again, there's no stock in this deal. Okay, Wrigley's share price. Next thing we need. Wrigley's share price, the date before the announcement date. Remember what that was? That was $62.45. Okay, that's what the press release said. I actually went and independently validated that myself. I went back to I think it was Bloomberg or Yahoo Finance or whatever the daily stock price was. Found that as of that date. Okay, once we enter that share price, you'll notice that the premium over here automatically calculates. It's basically taking what is the total value per share, comparing it to that share price. 28.1% premium. Make sense? Next item, basic shares outstanding. Where are we going to find that? Cover page of most recent filing, which in this case is a 10K. So my transaction filings folder, I'll open my 10K. Okay, and here's one of those situations where actually the share count has bled over onto another page. It's not on the first page. It's actually not even on the second page. It's on the third page. Very top of the third page, as of January 15th, 2008, there were outstanding 217.5 million shares of common stock and 56.5 million shares of Class B common stock. Remember that $80 a share applies to both. So we need to add these two numbers together to get our basic share count. Make sense? So 217, 515, 229. So in this basic shares outstanding cell, what we want to do, we want to add equals 217.515229 plus 56.453637. I'll just leave those numbers up for everyone. All right, 217.515229 plus 56.453637. All right, and make sure you have an equal sign at the front of that formula. If you don't have an equal sign, Excel doesn't know that you're trying to perform a calculation. When you hit enter, you should get 274.0. All right, remember, this is just our basic shares. We still haven't factored in dilution. Once we do that, it will increase our share count. Okay, and then this fully diluted share calculation here will actually go up. All right, so this includes our basic shares plus dilution, which we'll take care of down here. We haven't gotten there yet. So right now, these two numbers are equal. Once we do dilution, fully diluted share count will go up. Right? Okay, so we have right now, if we multiply that fully diluted share count times $80 a share, gives us an implied purchase price for the equity, $21.9 billion. All right, we need to add to that debt. We need to add preferred, minority interest, less cash. It's that total enterprise value formula so we can figure out what is the total transaction value. All right, so for debt, I'm going to go back to the 10K. I never can find this right away, but I'm looking for the balance sheet. Here it is. On page 104 of 193. So if you want to just get yourself there, you can type in 104 in that area there and hit enter. It'll take you right there. Actually, it's on the next page. It's 105. It's the liabilities and equity. Everybody find that? Okay, so I need Wrigley's total debt. Remember, total debt can include short-term debt and long-term debt. So I first look in the current liabilities section. Short-term debt is 0. Okay, so all I'm going to have is long-term debt, which is $1 billion. Okay, so back to my template where it says debt, I'm going to just type in 1,000. Remember, my model is in millions, so 1,000 means $1 billion. Preferred, minority interest, very easy. They're both 0. They don't have any. So we'll enter zeros for both of those. And then for cash, we'll get that right off the balance sheet. In this case, it's going to need to be 2 numbers, cash and cash equivalents, as well as short-term investments. Everybody see that? So for cash, it's going to be 278.843 plus 0.635. Be careful on the decimals here. Don't just enter 635, it's 0.635. All right, so that number should be equals 278.843 plus 0.635. Does everyone have that? You should get 279.5. So far, so good? Okay, next, we need to deal with dilution. Stock options, remember they all vest. So we need to go to the options table, back of the 10K. What's the easy way to keyword search and find an options table in an electronic doc? Keyword search, Control F for find. Type in exercisable. Okay, it's like the 3rd or the 4th. It's actually like the 4th hit. All right, you should get down to here. I'm on page 124 of 193. This is their options table. A lot more straightforward than some. They've basically got 2 lines, outstanding and exercisable. Which one do we want? Outstanding. Remember, they all vest. So all of those 14.87 million options will vest. So in our model, we're going to want to enter 14.87 at an exercise price of $50.16 per share. Okay? Just knowing that exercise price, what does that tell us? Are they in the money or out of the money? Deeply in the money. They're getting bought at $80 a share. The exercise price is $50.16. So they're deeply in the money. Means the option holders are going to make a lot of money on this deal. So everybody got that? 14.87 million options, weighted average exercise price $50.16. We do the treasury method, and it tells us that there's going to be an additional 5.55 million shares that get issued in connection with this deal to satisfy all those options. All right, so now we've got total enterprise value. All right, so we've got the numerator for our multiples. We've got the control premium that we're going to need to summarize in that table. All right, the last thing we need to capture is what was Wrigley doing on an LTM basis, revenues and EBITDA. All right, that'll give us the numerator or the denominator for those multiples. Also allow us to calculate the EBITDA margin, show how profitable Wrigley was. All right, and in this case, there are no recent 10Qs and last 10Qs. All we have is a 10K. What I want you to do is just delete all those out for the 10Qs. All right, so you can select those if you hold down Shift and then use your arrow keys. You can select these 4 cells and then just hit delete. All we really need to capture two numbers from our 10K. There are no 10Qs. Okay, so revenues, I'm going to go back to my 10K. Again, the financials started around page 105. Actually, it's on page 103 of 193, income statement. And my revenues for 2007, $5.3891 billion. All right, so for revenues, I'm going to enter 5389.1. And now we need to calculate EBITDA. Okay, so how do we calculate EBITDA? It's another word for EBIT. Operating income. We're going to add depreciation and amortization. We're also going to add back any non-cash, other non-cash expenses. All right, there are some. We'll show you those on the cash flow in a minute. But the first number we need is EBIT. So in our model, we'll say equals 962.772 plus. All right, and don't hit enter, just leave that open because we're going to add some numbers to that. Go back to our financials. We're going to go to our cash flow. So we need to add back depreciation and amortization. Okay, and they also had an unusual or a non-cash gain on retirements of property and equipment, so we're going to take that out. All right, so what I want to do is to that 962, I want to add 217.778 minus 11.441. All right, so again, this should be three numbers, equals 962.772 plus 217.778 minus 11.441. You should get like 1169.1, I think, for the final result. All right, so now we've spread the Mars-Wrigley deal. What we're going to need to do now is summarize that in our table up above. So I'm going to scroll back up to my table. Line 23, that's the Mars-Wrigley deal. Okay, the first thing I need is revenues. So I'm in cell K23. So I'm going to say equals. I'm going to link to cell AD42. And to link to something, you'll say equals, then you use your arrow keys and scroll over to it. When you get there, you'll have it highlighted and you can hit enter. So equals AD42. For EBITDA equals, I'm going to scroll over to AD43. EBITDA, hit enter. EBITDA margin, we can just calculate. Actually, the easy way to do this is this